A pump and dump is a manipulative scheme which is a two-part act. The first part is the pump part and involves artificially inflating the price of a stock through false and misleading recommendations, which is then followed by the second part of the scheme that requires the selling or dumping of these shares at that inflated price. For example, let's say I have a good number of shares in a company, and being the crook I am, I decide to run a pump and dump scheme. So step one is for me to spread fake news, wherein I'll say something like the company is going to get $100 million in contracts next week, or it's going to get acquired by an industry leader, etc., which may not be true, but the idea here is to hype up the stock's interest. Now, as the word spreads, more people will start bidding for the shares, and slowly but surely, the price of the share will go up by 20, 30, 50, even 100% over the next week or two. This takes us to step two, which happens when the stock price has gone up quite a bit, and that's when I will offload some or a lot of my shares at the inflated price, netting in a substantial profit in the process. This practice of pumping and dumping shares is clearly illegal, but given the nature of the industry and people's intrinsic desire to make a fast buck, these schemes continue to flourish, with the spoils going to a select few and at the expense of the ignorant majority. Pump and dump schemes generally target small and microcap stocks. And that's because these are a lot easier to manipulate, with these companies having a small float, which means the public shareholding is around the 25 to 30% mark. They have low trading volumes, there's limited corporate information, and typically no research analyst would be tracking the stock or publishing elaborate reports about this company. Now, pump and dump schemes were traditionally conducted through cold calling, and if you've seen The Wolf of Wall Street and those pink sheets, then you know what I'm talking about. In fact, while researching for this video, I came across a primitive but effective technique wherein the fraudster would leave a message accidentally on the victim's answering machine saying that some stock is going to go up by 3 times over the next week. Now, you know and I know that there was nothing accidental about that message, but since the poor victim had no idea of this, he or she would go ahead and buy that stock, assuming that Lady Luck had finally shined on them. Unfortunately, this would turn out to be nothing more than a ruse, and these victims would end up losing quite a bit of money. Over time, call centers and boiler room operations have given way to more technology-oriented communication modes. Today, scammers blast millions of emails and text messages. They hold webinars, are seen on dedicated YouTube channels, use Twitter, WhatsApp, Telegram, newsletters, and a host of new and secured communication platforms. A recent related example that was reported in the papers was that of Salazar Techno Engineering Limited. So this company, Salazar Techno, is a construction and engineering company which has heavy promoter holding and comes as a microcap company with a market capitalization of around 700 crores. The company has a proper operating business, and we did not find any reason to suspect anything hanky-panky going on with the company. But what came up as a red flag was a sudden and unexpected flare-up in interest when on the 7th and 8th of March, a number of Twitter handles started talking some really good things about this company. You see, what had happened is that one or more digital marketing agencies had made contact with these Twitter influencers and paid them some money to promote the stock of Salazar Techno. For example, take the case of Mr. Venkatraman, who was contacted by an agency asking him to write good things about Salazar Techno, including a prediction that the stock can reach 500 rupees by the end of this year. Other reports suggest that the agency was offering between 25 to 30,000 rupees for this tweet. And while it is not clear who appointed the digital marketing firm to promote the stock, the pump up did work, and Salazar Techno's stock price jumped up by 10% over 2 trading sessions. Of course, this would have given enough time to the operators who were inflating the price of that stock to dump some shares in the company at the artificially inflated price. Now, a lot like stocks, pump and dump schemes are being increasingly found in the cryptocurrency industry as well. For instance, this article here talks about how micro tokens like Squid, CocoSwap, and Ethereum Meta, with their minuscule market cap and extreme swings, can deliver ultra multi-bagger returns in just a day or two, only to have an equally dramatic plunge within a week or so. For example, take a look at Ethereum Meta, which surged by more than 235,000% in a matter of 24 hours, only to drop back to its pre-spike price within a week or two. In our opinion, pump and dump schemes have a higher chance of success in a crypto environment where, by construct, these instruments lack regulation, have low volume and liquidity, and are too complex for the average user to understand. In addition to the classic pump and dump, we also came across a variation called the short and distort, which works exactly in an opposite manner to a pump and dump. So instead of first buying the stock and then artificially raising its price before selling, in a short and distort, the scammer first short sells the stock and then artificially lowers the price. In essence, instead of talking wonderful things about the stock, now the fraudster uses criticism and negative predictions to bring down the price. And once that part is done successfully, the manipulator then covers his short position by buying back the stock at a lower price, thereby making a lot of profit in the process. Preventing market manipulation is the Securities and Exchange Board of India's primary objective, and it uses a three-pronged approach to handle this pump and dump menace. The first part of SEBI's strategy is surveillance, which is done by keeping a close watch on financial results, by having a separate vigilance cell called the Corporation Finance Investigation Department, and the SEBI has also invested in a data warehousing and business intelligence system which uses pattern recognition algorithms to identify violations, including pump and dump schemes. The second part of SEBI's strategy is prevention, and the regulator has been actively intervening in ways that we never thought was possible. For instance, an SMS is one of the easiest and most commonly used mediums for transmitting stock tips. Now, to stop this nuisance, SEBI asked the TRAI, or the Telecom Regulatory Authority of India, to create a special software that could identify certain keywords and block those messages. And the third part of SEBI's strategy to reduce pump and dump opportunities is education. A recent example of this, which also shows SEBI's no-nonsense approach, is when it asked the folks at Patanjali to put out advertisements in national newspapers discrediting an SMS that has been floating around. This SMS, in a nutshell, was singing praises of Ruchi Soya's follow-on public offer, or FPO, and was clearly aimed at exciting the retail investors' interest towards the offer by emphasizing the potential 30% discount on the stock's current market price. In addition to newspaper advertisements, SEBI also mandated the company to offer investors a window wherein they could cancel their FPO bids, which is probably the first time that something of this sort is happening. Step 1 is to be extremely suspicious of unsolicited investment offers. Unlike the 1990s or earlier, when someone would need to talk to you or write an official correspondence, today's investment pitches are just a comment, a tweet, an email, or WhatsApp away. More often than not, the source of the message is unclear, and hence, as a rule, always ignore all such messages. I use the word all quite deliberately here because even if the source is known to you, it's entirely possible that the source might be just reacting on a promotional message he received, like what we saw with Salazar Techno. Step number 2 is to look out for obvious red flags. These include promises of very high investment returns, in cases where a pressure is being exerted as a limited time opportunity, and of course, any claims made that the recommendation is based on insider or confidential information. For more details on how one can protect oneself from financial frauds, do watch a related video on this topic on our YouTube channel. A third area one needs to look out for are the promotional stuff. You see, there are many content creators on YouTube, Twitter, Instagram, etc. who have a certain bit of influence over their viewers and followers. Now, when these creators talk or promote a particular stock, it's in the investor's interest that he or she pays special attention to the disclosures made. In our opinion, there are 3 kinds of disclosures in these materials. The first one is no disclosure, which is something I'll be highly suspicious of and would not pay any heed to. The second type is a vague disclosure, wherein the creator doesn't really specify if anyone has paid them or not for this piece of content. And thirdly, there are buried disclosures in hard to read prints, which would go something like, we may receive compensation from companies we write about. Now, while every company, including mine and yours, has these terms, conditions, and asterisks, and since this is your money that's on the line, it is very important that you approach every advice on these mediums with extra care and caution. The next step, step 4, is one of the most important ones and requires all investors to conduct their own research and due diligence before investing. And if you are too lazy to do that, then you should explore leaving your money in the capable hands of a mutual fund manager or an intelligent investing service like ET Money Genius. Now, when I use the word lazy, believe me, I am not being harsh. And that's because time and again, we see average investors use below average skills to invest in instruments that come with above average risk. Take, for instance, Tire Rolls, which is a subsidiary of Tata Steel Limited and is in the business of manufacturing ingots, forged rolls, and pig iron. In the last 1 year, the share price of this company has gone up from 40 rupees to 124 rupees a share, which is a growth of 200%. But what may come as a surprise and shock to many is that Tire Rolls has not posted any revenue for the last 4 years. It hasn't made a profit in the last 13 years, and its net worth has been negative since FY 2016. The company is currently undergoing a corporate insolvency resolution process, but strangely, that hasn't stopped some market operators from trading vigorously in its stock, which frankly has all the signs of a pump and dump strategy. And the fifth and final step one can take to better identify pump and dump strategies is to learn more about them from newspapers, online magazines, newsletters, and blogs that often describe these new frauds with adequate elaboration. So help yourself by educating oneself, and if you haven't done that yet, then this YouTube channel should be a wonderful resource and a trusted companion to you in your financial journey. And with this, we come to the end of this video. I hope you found some nuggets of information that you can use or share with others who might need this information. I thank you for your time. Do like this video, do tap on to that subscribe button, and I look forward to catching up with you next week. Until then.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.